In this week's video, we'll review a wide array of charts and data to help us better understand why demographics say the bull market could still have a long way to run. Since there's a lot of detail in this week's video, feel free to use the pause button on your video player. You may remember from last week's video, we used this chart in the center of your screen dated September 15th to talk about trends and similar trends historically relative to the move in the S&P 500 off of this low here on March 23rd. 15th was 541 calendar days from that low. You may also remember in the historical cases, looking out 1 year, 2 years, 3 years, 4 years, and 5 years, really good things happened. In every single case, the S&P 500 was higher 5 years later, 4 years later, 3 years later, and 2 years later. Given the S&P 500 has moved a long way since the March low in 2009 and the March low in 2021, logical question might be, how is it possible that the stock market could perform potentially this well looking out 1 to 5 years? There are obviously numerous ways to answer that question. This week we will focus on demographics and their impact on the economy and the financial markets. The chart on the left side of your screen does a good job helping us visualize earnings over someone's lifetime. When you're 0 to 15 years old, you really don't earn a lot of money. And then later in life, you tend not to earn a lot. And the sweet spot for earnings tends to come in this area here relative to age. And common sense tells us that for most of us, when we earn more money, we tend to spend more money. And historically, peak earning and spending years tend to fall in this window here, between age 35 and age 54. Now let's use some simple graphics to illustrate basic concepts about demographics and the financial markets. When we're younger, we tend to consume more than we produce. And when we're older, we tend to consume more than we produce. On the other end of the spectrum is that sweet spot for earnings and consumption, and that falls typically between the ages of 35 and 54. Those in the 35 to 54 category typically produce more than they consume. And common sense tells us that a lot of economic, market, and social outcomes are tied to these concepts. Demographically, what percentage of your population is up here and what percentage of your population is here and here. On a relative basis, when this demographic set tends to be smaller relative to this demographic set and this demographic set, we tend to get stagnation economically, and that's when we have secular bear markets. Things tend to be more difficult economically and in the financial markets when you have a big drag on the economy demographically. Conversely, when this group up here is relatively large relative to this group here and this group here, good things tend to happen economically, booms, and we tend to get secular or very long-term bull markets. So let's take the concept of demographically driven economic stagnation and demographically driven economic booms and bull markets and tie it to a long-term chart of the S&P 500 index. This is 1930 on the left side of your screen, the present day September of 2021 on the right side of your screen. According to Pew Research, the baby boomers were born between 1946 and 1964. And after their birth window, financial markets didn't do particularly well for quite a long period of time, denoted by the orange box where my cursor's moving around. Then in the early 1980s, things started to change. In 1981, the oldest baby boomers turned 35 years old, which means from a consumption perspective, they were right here in the early window of that demographic sweet spot that spans between age 35 and 54. Since we already know the oldest baby boomers turned 35 in 1981, might be helpful to know, when did the oldest baby boomers turn 54? The answer is the year 2000, at the end of this 18-year secular bull run in the S&P 500 that started at this low here in 1982. And in this window from here to here, we have this massive generation, the baby boomers, in their peak earning and spending years. Got a very, very large group in a favorable area, relatively smaller percentages of the U.S. population out here and here. So at this point here, the oldest baby boomers are now leaving this demographic sweet spot, and they're starting to fall into this area where they become a drag on the economy. And that problem only became worse in the subsequent years, and the S&P 500 and the economy didn't do nearly as well in this area here, denoted by the orange box, relative to the secular bull from point A to point B. Favorable demographics in here, much less favorable demographics inside of the orange box. Now we've looked at the baby boomers from 1946 out to 54, and then also in here when they start to become a drag on the economy. What about the millennials? The millennials were born, according to Pew Research, between 1981 and 1996. The oldest boomers hit their peak earning and spending years in 1981 when they turned 35. Something similar happened for the millennials in 2016. And remember, demographically, one of the most important things is the relative size in terms of the percentage of your population of this group here relative to this group here and this group here. Thus, it's relevant when the millennials hit 35 in 2016, but it's also relevant that in 2019, where my cursor is here, the millennials overtook the baby boomers as America's largest generation. And very, very similar to this point here in 1981, in 2016, what ended up being the largest generation a few years down the road was on the front end of that demographic sweet spot, which means walking forward from approximately July 1st, 2019, we started to get a favorable look here. And really every year that passed, this was starting to get more favorable as more millennials move into this area here between 35 and 54, and the mortality tables start to catch up with higher and higher numbers of baby boomers. Oldest boomers 35 in 1981, oldest boomers 54 in the year 2000. Age 35 here, age 35 here, age 54 here, near the peak in 2000, age 54 here as they're leaving the sweet spot. Thus, it might be helpful to know, when will the oldest millennials turn 54 years old? The answer is not until 2035. Thus, you can make an argument that 1981 is similar to 2016, and demographically the year 2000 is similar to 2035. And given it's only September of 2021, that would be several years down the road. And we know from this point A, which is similar to this point A, that really, really good things happen in the stock market for a long period of time, and thus far seem to be following the script quite well after a breakout from this box here in 2013, and then somewhat of a retest look here in 2015, 2016, much like this period here above the orange box where my cursor's moving around. Really, really good things have happened thus far. Since demographics are far from an exact science, it can be helpful to look at this from several different angles. If we find the midpoint for the birth window of the baby boomers, right around 1955 where my cursor is, a similar exercise for this birth window for the millennials would take us to 1989. From the midpoint of the baby boomers' birth window in 1955 to the end of the secular bull run, that was 45 years. Hypothetically, if the present-day secular bull ended in a similar window, from this area here out 45 years, we would be looking at a secular bull that would last until approximately 2034, which is very, very similar to when the oldest millennials turn 54 years old in 2035. There are numerous ways to look at this, including taking into consideration that in 2021, the youngest millennials are 25 years old, and the oldest millennials are 40 years old. So if we tried to find a similar spot relative to the boomers, the oldest boomers were 40 in 1986, and the youngest boomers were 25 in 1989. Thus, demographically, we can make an argument that the present day, or 2021, is similar to the 1986 to 1989 window. Thus, we can make an argument that the present day is similar to early in calendar year 1988. If that's the case, then relative to this secular trend here, here's 1988 here, this point here is similar to this point here, and it does look similar. The market does very, very well in here, and then it consolidates for a long period of time, has a breakout, somewhat of a retest look here, and then rallies for several years. The market does very, very well. The market does very, very well. It consolidates for a long period of time. It consolidates for a long period of time. Has somewhat of a breakout and a retest look. Has somewhat of a breakout and a retest look. After the retest, it rallies for several years to this point here. After this little retest, it rallies for several years to this point here. Thus, if 1988 is similar to 2021, walking forward from 1988, good things continued to happen in the S&P 500 for a long period of time. The market continued to rally from 1988 into the year 2000. If we saw something similar from 2021, it's possible the secular bull could last until 2033. Thus, one estimate says the bull could end around 2033. Another one says 2034, and a third says 2035. And the most important takeaway from this exercise is not to say the present day is 1988, and we expect the stock market to follow the exact same path as it did walking forward to 1988. That's not it at all. The purpose of this exercise is to say we have a lot of evidence, both technically and demographically, that the S&P 500 is currently in and remains in a secular bullish trend that could last for several more years. Also noteworthy, we said the present day could be anywhere, using this analysis, between 1986 and 1989. So let's continue with the assumption that we originally made, that we're maybe somewhere in 1988 here. Last year proved that really, really bad things can happen within the context of a secular bull market. Right here, the COVID plunge. Here, 1987 would be in the rear view mirror. So this year, 1988, does have some similarity to this plunge here and the fact that the market righted itself. This plunge here and the fact that the market righted itself. And remember, for us, the most important takeaway is the secular trend thesis, helping us keep an open mind about much better than expected outcomes in the stock market, looking out several years. And you might remember recently, we did an analysis based on quarterly CCI. Notice this is technical. It has nothing to do with demographics. Quarterly CCI recently hit this green line here. If we go all the way back to 1930, once again, the only times that quarterly CCI has hit the green line is within the context of a secular bull market, within the context of a secular bull, or right before this secular bull kicked off, and within the context of a secular bull here late in calendar year 1995. After this point here, from a long-term perspective, really good things happened. After this point here, from a long-term perspective, really, really good things happened. In 1995, walking forward, really good things happened with relatively muted drawdowns between point A and point B. And the only other time that quarterly CCI has hit that level, calendar year 2021. Once again, we have evidence in hand that ties the present day to periods that we really already know without a shadow of a doubt. This is a secular trend, and this is a secular trend. Since we can make a rational case that 1988 is similar demographically to 2021, It might be helpful to ask and answer. How did stocks perform in the 1988 to 2000 window spanning 13 years? As you might imagine, within the context of a secular bull market, the answer is extremely well. Walking forward from this point here, which is similar to 2021, the S&P 500 was up almost 200% 9 years later, and 12 years later, it was up over 400% and pushing 500%. And keep in mind, right here, we could have said there is no possible way the stock market can continue to go up because it's basically been rising since this major low in 1974. In the present day, we can say there is no possible way the stock market can continue to go up because it's been rising since this low in March of 2009. And yet, within the context of favorable demographics, the secular trend did continue to go up, and it went up a lot more than most expected over the next 13 years. So back to last week's video. It would have been very, very easy to say last week, there is no possible way that anything even remotely close to this table on the right side of the screen could play out in the coming years. It's also interesting to ask and answer. How do these long-term projections on the right side of your screen looking out 5 years, and more specifically, the average gain of 81% and the median gain of 70%, compare to the projection that we just covered based on demographics? So to make it a little simpler, let's take this average gain here and this median gain here and find the midpoint. The midpoint was a gain looking out 5 years of just under 76%. How does that 76% figure looking out 5 years compare to the 5-year projections based on the demographics? Very, very similar. 5 years from 12/31/1987, the S&P 500 was up 76.34%, which is very, very similar to 75.7%. So for clients, there's really nothing new here. Our base case for several years has been a secular trend, and this analysis is not particularly new. This is an updated analysis, and every time we do this analysis, we start from scratch because it's incredibly important to understand these demographic concepts when the market experiences inevitable pullbacks and corrections. The Monday of this week was incredibly volatile. And remember last week, based on this analysis, we covered these dotted horizontal lines and said based on history, wouldn't be particularly surprising if the S&P 500 backtracked to any one of these areas. And we also said another good way to look at it, and we covered that on September 17th, was this A to B move here, even just the move from May to the peak in early September, a 61.8% retracement of that move would take us down to about 42.40. If you follow along on Twitter, here's the handle here, you know that during Monday's session, we tweeted an updated version of this chart. When we tweeted it, the S&P was down 58 points. And this is not a particularly alarming look here. At 9:48 a.m., we weren't even below the 38.2% retracement of that A to B move that we talked about last week. And as it turns out, at the close on Monday of this week, we did hold right around that 38.2% level, which is not a particularly important level, but it's basically saying this is even a normal give back on this type of move from here to here. So relative to what we talked about last week, nothing's really changed. The June low would still be a relevant level, a level that we've talked about and tied to historical analysis several times over the past several weeks or months. The June low is still part of our intermediate term base case. During the session on September 24th, when this video is being recorded, the S&P 500 was about 284 points above this June closing low. And as you can see, From this version of the chart, during Friday's session on September 24th at 1 p.m. Eastern Time approximately, we still have an incredibly strong trend look, with blue the fastest moving average on top and the slowest moving average, the 250-day down here on the bottom. The slopes of all of the moving averages remain up, and for the most part, price has remained above all of the moving averages. So during Friday's session, we still had a full-bore bullish look. And this is exactly what we would expect to see during one of the stronger parts of a secular trend. So just as this June low is somewhat of a we should pay closer attention if the S&P 500 drops below this level, and more importantly, stays below it, we can continually ask, if the base case from a long-term perspective is a secular trend, does the present day still align with the base case? If the answer is yes, that's helpful information. And if the answer is no, that's helpful information. It doesn't change anything relative to our approach of trading the chart in front of us. And just as we talked about on Friday, September 17th, it's incredibly important to have realistic expectations about how markets operate in the real world. Thus far, this looks like a 100% normal and to be expected pullback. And that's a statement based on what we know today. The same concepts apply to secular trends. It's very, very easy to watch a video like this and expect the stock market to go up every day, every week, every month, every quarter, and even every year. It just doesn't work that way in the real world. This is a secular trend here. There's a ton of volatility between point A and point B. Secular trend here between point A and point B. There's a ton of volatility, including the 1987 crash between point A and point B. The demographic analysis helps us with the long-term base case and establishes long-term reference points that we will most likely cover in future weekly videos. Just as this chart that we covered a week ago helped us with intermediate-term reference points. And we all know the only way that we can answer the question, does the present day still align with the secular trend thesis? And the only way that we can properly answer the question, does the intermediate term base case still seem to align with the data in front of us, is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.